Hello, I'm Carrie Ann, local mortgage broker here in Caloundra again. So I'd love to talk to you today about avoiding mortgage traps. Yep, so we're going to talk about some of the common mortgage traps that people can fall into. So starting out with, let's look at debt consolidation. All right, so a lot of people will do debt consolidation because we have a loan term on a house that's up to a 30-year loan. They might have 25 years left. You've got a car loan over here at 7 years or 5 years. You've got credit card. You've got 2 or 3 or 4 car loans or business loan and credit card or whatever. You've got all these different sorts of interests and different payments and so forth. So they take all that, they'll go and stick it over here on the mortgage and use it on the equity of the property and lowers all the payments and so forth on all of those debts, clears all the debts, and lo and behold, they've got it cheaper. The only thing you're doing that, you might end up having to pay a lot more in interest down the track. The good idea is, it is a great idea to do, as long as you are diligent, you know what you're doing, it's good to do. So you get financial advice or whatever on that, but you can do that as long as you understand that it's going to eat into your equity of the property. You look at making some extra payments to break them down because it is a cheaper interest rate. So if you're going to move, say, the car loan over from a 12% interest rate to a 6% interest rate, you're halving the interest rate, but I would still keep up the same payments that you're making there. Put that extra over there. If you're finding that it's costing you quite a lot of money and you need to be able to breathe a bit better financially, even if it's half extra or making more extra payments on that and paying that up a lot quicker and bringing that down. So that's a really good idea to do that. So sorry if I'm stumbling, but you know what I mean by there. The other thing might be an extended loan term, which we just covered. So we just talked about the extended loan term. So you've got and also if you're going to go for a car loan, try and do it on a 5-year instead of a 7-year or spreading it out is a really good idea as well. So we talked about the impact on the home equity. We've already done that as well. So the other things that we need to look at for common mortgage traps are interest only. So a lot of people go for an interest only home loan, particularly not so much their own home, but they will do that very much so on an investment property, and that other people will pay off the interest, and it's basically to get them into the property or whatever. It's not going to pay down any principal on the house. It's not a good idea. If you want to refinance, you have no equity in the game, and so it's not a great idea to do that. It's a good idea to do it if you're looking, it's a great investment at the time, you want to get in, it's a good idea to do an interest only. Or if you're looking at purely just for cash flow and looking just for the income, yeah, you can do it for that as well. As long as the property over long term is going to go up, you must remember you are only paying interest on the money you borrowed. Simple as that. It is what it says. Honeymoon traps. Here a good one. So the bank will offer you a honeymoon trap. Now, what that means is they'll offer you a loan, much cheaper interest rate, but it's only for about 12 months, even 6 months, maybe 18 months if you're lucky. So they do that to get your business. And a lot of the times the interest rate could be a lot higher than what you're going to end up with if you already just went with a different lender. So it's something you really need to look into first before you start doing honeymoon loans, introductory loans, honeymoon loans, or whatever they call. Cashback offers. Cashback offers from banks to do a refinance to get your business is another really good lure. The main reason they do that is because usually whatever they're offering is basically what's going to cost you to refinance over anyway. So highly suggest talk to your mortgage broker about myself. Give me a call and I'm happy to chat with you about anything. So look into everything it's going to cost you. So particularly with anything I've said so far. There are lots of other things to think about, extra fees. Also, bridging finance. I wanted to talk about a little bit about bridging finance. If you're not sure what a bridging finance is, what it is you like a property. I really want that property. So you can do a bridging finance. So you can buy this property while you're selling this property. It's pretty much that simple. So you get this loan over here, and when this loan is settled and that's paid out, you just pay that off and away you go. So you got to remember it's going to cost you a lot more money to do that too. So they're not cheap option to do, but they're an option offered to you that if you know for sure that your property's selling, or you've got a contract, it's a sunset clause or whatever the case might be, just make sure that you have a really good talk to someone about before entering into a bridging loan, because a bridging loan is a really good tool. It is a tool, but it's not for everyone. The other one I want to talk about is fixed rates. Fixed rates are offered between 1 to 5 years. The thing is with fixed rates, they can be good, but we don't have a crystal ball to know whether the interest rates are going to go up and down, or property is going to fluctuate up and down either. So the thing is with interest rates, what will happen is this bank might be offering 5.9%, right? You go, oh, I'm going to fix it that, or fix it 5.8 or whatever. But you'll find out sooner or later that the fixed rate, for a fixed rate, it's not. It'll be 6.2% or 6.3%. It always will be a little bit higher. Usually not by much, but it usually is. And that's just a cover for the bank to do so. But the fixed rates can be a bit of a trap. So just say that you need to have a variable loan because you have an offset account. You've also want to do a redraw on that as well. You won't be able to, not with a fixed rate. So when you've got a fixed rate, you've fixed it. It means that all the money that goes in there cannot be touched. So not sure if banks have changed some of the rules, and some lenders might be a little bit different on that, but also that's another thing, because banks do change their credit policy on a daily basis just about. So that's something to ask about, and to make sure that you're not going to get caught in a fixed rate and realise, oh my God, I can't do a redraw, or I can't do this with it, I can't do that. There are quite a lot of stipulations when it comes down to fixed rates. Anyway, so there are some of the points I have explained in quite detail in a blog post. So the link to that is down below. So if you want to have a read of that, you're more than welcome. I'm happy for you to have a comment on that. Or if there's something else that you think I've forgotten, or there's something else that, that you'd like me to even talk about. So put a comment down below and make sure you subscribe. And I always give a lot of education and hints and tips on all things finance. Okay, so see you later. I hope you found the information useful. If so, make sure that you subscribe to the channel. And I just want to let you know that we have a free giveaway, a free book, and subscribe to it now. So the link is below. It's the 7 steps to mortgage freedom and wealth through property. Inside here, you will find out how to get the cheapest home loan, why you should really care about your home loan, why people will end up broke, and also we have some bonus chapters at the back here as well. It's a great read. It's an easy read as well. So make sure you get your copy and share it with friends. See ya.